In this video, we are going to talk about the forward price of a non-dividend paying stock. This is really the simplest example we have, which illustrates what we call the arbitrage pricing methodology for derivative securities. This technique is going to show up again and again, so it's worth understanding, at least in the simplest case. So first, a forward contract is a contract to buy or sell an asset for some price at some point in the future. The forward price is the price that makes this contract fair, and we're going to define fair as having zero present value. We should start by just giving ourselves a little example which says that forward prices do exist. So imagine there's a stock trading today at $100 and someone offers to buy it from you tomorrow for $1,000 with no upfront payment today. Or alternatively, imagine that they instead offered to sell it to you for $1 without any upfront payment. Both appear to be bargains, right? There might be something strange about this stock, but if I've got something worth $100 today, my best guess is it's going to be worth something like $100 tomorrow. Someone offers to buy it for me for $1,000, I'm pretty happy. On the other hand, if it's worth $100 today, and someone offers to sell it to me for $1 tomorrow, I'm still pretty happy. So in both cases, I feel pretty happy. In both cases, that happiness, I guess, translates into a non-zero present value. What does it mean? It means there's some price, probably near 100, but there's some price between 1 and 1,000. That's fair. So there should be a forward price. Okay, finally, to understand prices, we're going to have to talk a little bit about the market. So we're going to look at the market, and we're going to simplify the market and have two kinds of market participants. Clearly a gross simplification here, but it gives us a handle, it gives us an understanding of where these prices come from. So we're going to have dealers. Dealers are going to make prices to buy and sell an asset. They're going to make a bid, the price at which the dealer will buy, and an ask, the price at which the dealer will sell. And the bid is below the offer or the ask. All right, so the dealer will sell a little high, buy a little low, and dealers make money from the spread between these prices. That's their job. And dealers typically do not take directional views on the asset price. So second, we have clients of those dealers. Clients take prices to buy and sell the asset from the dealer. Clients are known as market takers. Clients generally lose a little bit of money every time they trade. They buy for a little bit too much, they sell for not quite enough, and they lose money when they trade. Now, that's not usually why they're making money or why they're trading, right? A client is not trying to capture the bid-ask spread. A client generally is taking a directional view on the market. They buy, let's call it a stock, they buy the stock because they think the stock price is going to go up. They pay these bid-ask spreads as a means of getting access to the market. Now, classic market making, and again, we think about this in stock trading and so on, is that the dealers understand the market such that if a client buys from them at the ask, the dealer immediately goes and buys from someone else at their bid, and they make the bid-ask spread. Or alternatively, if a client sells to them at their bid, then they immediately go and sell to someone else at the ask, and again, make the bid-ask spread. They're taking risk because if they can't execute the second trade fast enough, the market can move against them. What I'm really trying to say here is perspective matters. When thinking about prices, we have to think about whose perspective we're taking. And given that dealers make the prices and the clients take the prices, we should work from the dealer's perspective when trying to determine prices. Okay, one last thing to talk about, arbitrage. Arbitrage is the ability to make profits without making an investment or taking risk. Typically, again, a client of a dealer loses money on the bid-ask spread. They pay in order to participate. If a client buys a share and immediately sells it, they lose the difference between the bid-ask spread. Dealers will set their bid-ask prices, set their market, to ensure that arbitrage does not exist. If they make a mistake and provide an opportunity for others to make free money, to capture arbitrage, then they will always trade on one side of the market. We're going to assume the market's smart enough to be able to find these opportunities. If their bid price is too high, they always buy. If their ask price is too low, they always sell. If they find themselves always buying or always selling, then they know they need to adjust their prices. All right, some assumptions in order to figure out the forward price. First is about this arbitrage. The dealer will set their prices so that they do not provide an arbitrage opportunity to the market. Second, there are no transaction costs when trading the asset. Third, there's no credit risk in the market. Both counterparties in the transactions will always fulfill their obligations, and no margin or collateral will be assessed against the transactions. There are no intermediate cash flows arising from a position in the asset before the forward date, before the forward contract expires. All transactions do not have market impact. And finally, we can short the asset in some way. Now, some of these assumptions can be relaxed. So we could take account of transaction costs. We could manage credit risk through margin and collateral. We could handle intermediate cash flows in the asset. For our purposes in this example that we're doing, the non-dividend paying stock, we're not going to relax these, but we know that we can in the future. All right, so let's figure out how we calculate a forward price. A little bit of notation. S is going to be the spot price today. F is going to be the forward price today. That's not the quantity that we know today. T is the time until the delivery date, maturity of the contract. R is the risk-free interest rate for maturity T. We're going to let R be continuously compounded. Doesn't really matter. We could choose anything. Assumptions about the asset. We're going to have an asset that has no yield or income and does not cost anything to borrow. And our example that I keep talking about is a non-dividend paying stock, a stock that is not expected to pay any dividends. We are going to take the dealer's perspective, and we want to figure out a market for a forward contract. The way this market's going to work is we're going to try to find out the bid, this bid strike. K bid, K is the usual term for strike, or usual notation for strike, and K ask, the ask strike. Again, the bid strike is the price at which the dealer is willing to buy, and the K ask is the price at which the dealer is willing to sell. K ask is bigger than K bid. Now this contract is going to be traded with no upfront payment from either party. So we want to determine K ask, the price at which we're willing to sell. So a client approaches us to buy the asset, time T with no upfront payment, and we're going to agree to the following transactions. Today, we agree to sell the stock forward at time T for K ask. We borrow S at the risk-free rate. Remember, S is the stock price. We buy the stock. Now we wait until maturity, and at maturity, we take the stock that we own, we deliver it into the forward contract to our client, and we receive K ask. We repay our borrowing, S e to the RT. And we're done. After maturity, we have no positions left, and we always end up with K ask, the money we're paid on the forward contract, minus S e to the RT. For this to be a profitable strategy, it must be that K ask is bigger than or equal to S e to the RT. If we set K ask equal to S e to the RT, we always end up with nothing in the future. The present value must be 0. All right, let's look at K bid. This is the price at which we're willing to buy the asset. So imagine a client approaches us to sell us the asset at time T with no upfront payment, and we're going to agree to the following transactions. We're agreeing to buy the stock forward at time T for K bid. We borrow the stock today. We sell the stock, receive S, and we invest S at the risk-free rate. And then we wait till the maturity of the forward contract. We redeem the investment for S e to the RT. We pay K bid, receive the stock, and then we return the stock to the lender. Remember, we borrowed it at the beginning. At maturity, we have no positions left, and we always end up with S e to the RT minus K bid. For this strategy to be profitable, it must be that K bid is less than or equal to SE to the RT, and if we set it equal to SE to the RT, we always end up with nothing in the future. Present value must be 0. Knowing these two things, given that either strategy has 0 present value, if we set the strike to SE to the RT, we call this the forward price. So the forward price is equal to SE to the RT. And we know that if we set K bid to be less than the forward price, and K ask to be bigger than the forward price, then we're always going to make that spread if we follow this strategy. Now we should just investigate for a second what happens if we don't do that. So let's say we set K ask too small or K bid too big. Right? K ask, the price at which we're willing to sell, to be too small, or K bid, the price at which we're willing to buy, too high. Well, first off, we can't follow our trading strategy. If you look at those trading strategies and you look at these two examples, what you'll see is that we guarantee a loss. So we can't follow this. We must follow classic market making, meaning that if we buy from a customer, we have to sell to another one, or if we sell to a customer, we have to buy from another one, and so on. So we have to follow classic market making to make the bid-ask spread. But there's a problem. Most likely, dealers or clients who understand the trading strategies will trade against us and make money. We'll find ourselves always buying or always selling. And again, if we find ourselves in that situation, we have to recognize that something's wrong with our prices and we have to change them. This is pretty straightforward. These are straightforward strategies. So if we set K ask to be below SE to the RT, we are always going to sell. If we're always going to sell, we're going to have to move prices up. Eventually, we'll move our price, K ask, up to be above SE to the RT, and that will go away. So we will find ourselves in a situation where we need to change our prices. Again, these are pretty straightforward calculations. Something's kind of gone wrong if we set these prices incorrectly. Now, the thing to recognize is we have created a new way of making markets. This is an alternative to the classic market making strategy for forward contracts, right? Instead of selling at the bid, buying at the ask, we can go long or short the forward contract, follow this strategy, I would call it a hedging strategy or trading strategy, and we're going to make money as long as we can execute the trades fast enough. So we do the forward contract, and then we follow, I guess, call it the recipe that tells us what to do. All right, so let's do an example. We've got a non-dividend paying stock. It's trading at 110. Risk-free rates are 4%, and we want to find the 6-month forward price. And then we want to talk through the market making strategies for this price if, as a dealer, we add and subtract 50 cents from the forward price to find the bid-ask strike. So first, the forward price. Pretty straightforward. F equals SE to the RT. So that's 110 e to the 0.04 times 0.5, which is 112.22. We're going to set our bid and ask to be 50 cents above and below the forward price. So that's 111.72 at 112.72. So that's our market. So a client comes in. Let's say we go short. So the client wants to buy from us at 112.72. We go short. We go back to our recipe and we go, oh, what do we have to do? Borrow 110, buy the stock, and wait. At maturity, we deliver the stock into the forward contract and we receive 112.72. That was the contract we agreed. We repay our borrowing, 110 e to the RT, 112.22, and we make 50 cents. On the other hand, if the client comes in and sells to us, they're going to sell to us at 111.72. That's what we would agree. We immediately borrow the stock, sell the stock for 110, and invest the 110 at 4% for 6 months. At maturity, we redeem our investment, 112.72. We buy the stock for 111.72. That was that forward contract we entered into. We take the stock, we return it to the lender, and we made 50 cents. So in either case, with this market, we don't have to follow this the classic market making. We get to follow this, what I would call derivatives market making, and we make the 50 cents no matter what. Now note, if we had followed classic market making, we would have made more. We would have made $1. The problem is in the derivatives business that this forward contract is not going to be as liquid as the underlying asset. So it might be very difficult to make a market and be able to trade the other side immediately. We'll see this in options. There's so many strikes and so many maturities that it just doesn't work. So instead we have this alternative strategy. We buy or sell the forward contract and we execute this hedging strategy, and we often think of this as half the bid-ask spread, but we make the spread between the bid and fair or the ask and fair.